Welcome to another episode of Revolutionary G Talks. For those that don't know me, first of all, welcome to the show. My name is Giselle Ureña, and I'm so excited that you're here because I have an amazing guest, which I say this with everybody, but let me tell you, this one you want to listen to because we're going to talk about financial stability, personal, business-wise, and how to build generational wealth. Please help me welcome Queen Sabrina. Thank you so much for coming. I didn't say your last name because I didn't want to butcher it, but I'm going to tell you. I'm going to let you do your little intro for the guests. Who are you?
Yeah, absolutely. Well, hello, everyone. My name is Sabrina Antoine Correia. My last name is Cape Verde in Portuguese, and so it's pronounced Correia. But in English, it's Correia.
Oh, so, get that right.
A little R. But yeah, so I'm excited to be here to talk about personal finance and what does that mean for people's lives when they think about building wealth for themselves and when they think about generational wealth. So
Oof, I love
I'm ready to get into it.
Let's get it. So what is your background? First of all, what is your background personally? And then dive into your professional one.
Okay, so personally, I am Caribbean American. And so I was born in Grenada, and we came here in the mid-90s to Boston, and I grew up in Dorchester and Roxbury.
That's right.
If anybody knows, this is in the city of Boston, because this, you're international, honey. So we got to say where we're at. So in Boston, Massachusetts, in Roxbury and Dorchester, and I grew up here. I moved around a little bit, so I lived in different places. I lived in South Florida for a bit, lived in North Carolina for a bit, New Hampshire for a bit, and back in Boston, which is my home base. And super excited to be here. And when you were just asking about my background, so I have a unique background in finance and in nonprofit. And so this space and this season that I'm in, I'm a financial coach and a community organizer. And so a lot of the work that I do really do focus on the Black and Brown communities and specifically focus on what does it mean to have great and strong personal finance as your background so that you have the ability to build wealth.
Something we've been limited to have.
Something that, and sometimes it really takes education, right? And I tell people, like, my business model is all about building confidence so that you can build wealth. 80% of personal finance is mindsets and habits, right? It's behavioral. And a lot of people don't understand that. And 20%, there's math involved, but it's 20% of what it means to be in personal finance. So I'm excited to get into it.
Yes, thank you. I mean, do you hear that? So she's the one that you want to be listening to when you really want to tap into your financial goals. So my first question to you, the first topic that we're going to dive into is personal finance. So we're going to talk about credit. What is credit and how does credit impact our personal financial stability?
Yeah, credit. So that's the big thing, right? The solid, very straightforward definition about credit is buy now, pay later, right? That's what credit is borrowed money that you get to use to buy what you need to buy now, and then you pay it later. And sometimes paying it later also means that there's interest involved, right? But there's different things around credit that people should know. People should definitely know about the credit bureaus, and that there's 3 of them that has your credit reports, right? And so when you think about a credit bureau, that is Experian, TransUnion, and Equifax. Those are the 3 areas, the 3 bureaus that are commonly used to do your credit reports.
Yes.
And then there's your credit score. And this is a 3-number value, like three numbers that really identifies like what your behaviors are when it comes to credit. I will stop and just say this, right? Credit is important, and I know we're talking about credit and personal finance, but with anything in personal finance, it is very important to understand what your goals are in your financial life. And I say financial life, but I'm really talking about just life, because we have life goals that have financial implications.
Absolutely.
And that's important to know, right? And so what are those life goals that have financial implications so that you can think about what to do with your money?
Yes.
So that your money can work for you. Money is a tool.
Oof.
Money is a tool to get to your goals. And so credit is just a tool, right, to get to some of your goals. So I do want to say that first.
And before we even keep going, there is a stigma that we think we're defined by our financial stability, that we're defined by our credit report. We're defined. Can you speak on that?
Yeah, I think a lot of people kind of look at the credit score as like who you are as a person. And it's like, it's not the end all be all, right? It is about behavior and how you utilize credit, buy something now, pay it later of borrowed money. But it's not the end all be all, right? It's really about establishing good habits. It's a formula, right? Once you understand and get the formula down pat, you stick to that habit, you'll do great. But it's not the end all be all. And again, what is it? Why do you even care about a credit score, right? That goes back to your goals, your financial or your life goals. If you start thinking about people who may want to own a home someday, that's a life goal that has a major financial implication. And with that might be some folks' biggest purchase in life.
Oh, yeah.
So yeah, your credit score may matter, especially if you're not paying straight cash, which most people don't have the money to pay straight cash for a house. Then secondly, if you want to finance a car, right, that's going to be important. Get a credit card so you can make purchase some things that may cost more money than you can pay. So, it just depends on what those goals are. And that's why I think it's important to talk about that before talking about the actual three-digit number.
So before we dive into the actual logistics of credit, talk to us about that mindset that you said. What was it, 80%?
80%.
It's 80, not even 50.
Right?
So how can we learn how to navigate the ways that our thoughts influence our actions? Because, let me tell you, I know there's been a lot of impulsive decisions, a lot of, if you're in a really bad situation, you let the situation navigate instead of you navigating the problem. So why don't you dive into that?
Well, yeah. And I'll say this, Queen, like one of the things to think about is actually unlearning, right? A lot of our relationships with credit comes from unlearning the behaviors that we've seen in either in our households, in our community. We often hear people say, I don't like credit. I have a bad relationship with credit.
They become fearful of credit.
They become fearful of credit. And really it's just about establishing what's in credit that you need to be good at so that you can just like shift. And that piece is the education piece. So let me just talk about what's in that pie.
Let's go.
So 40% of what makes up your credit score is payment history, right? Buy now, pay later. 40%. So we're already on the high end. If you buy something with credit, make sure you pay it and pay it in full before the term is up. That's 40%. 21% is credit history. And I want to talk about that because sometimes that unlearned behavior, some people don't actually get credit at a time that they should. They wait because they're like, I'll use my debit card, I'll use my cash to pay my means, and all of this time you could have been building credit history. And so it's so important for folks to know, like, if you someday need to get a credit score because you have these lofty goals that you want to set, establish credit early. Establish credit early so that you can start these habits. So that's 21%. 20% is credit usage. Now, this is the big piece, and this is actually a piece that a lot of the folks in our community kind of fail at, just to be honest with you. 20% of what makes up your credit score is your credit usage. Your usage amount ultimately is how much is your credit limit, and whatever that credit limit is, do not go over 30%. Right?
Say it again.
Do not go over 30%.
Don't max that out.
Don't max that out, right? So like say you're someone who gets $1,000 in credit, right? 30%, that means what? $300. They don't want you to use more than $300 month to month. Because the moment you do, it automatically hits your credit score and your credit score goes down. And people don't realize that they're constantly playing catch up because their credit usage is over 30%. Every month they're over that amount and they're constantly trying to figure out, well, I'm paying the minimum, but you aren't able to actually get over the hump because your usage is over 30%. And that's 20% of your overall credit score. Just those three things make up 81% of your credit score. Those three things that I just mentioned.
Wow.
Payment history, credit history, and usage.
Wow. And what do you have to say in terms of that credit line? People think, oh, only have one credit card or only have one this, one that.
Yeah.
There is impact and importance in leaving that credit line open.
Yeah, you should leave that credit line open. And I always tell people, don't go applying for credit cards month after month, right? Because that also hits and impacts your credit score. That also impacts your credit reports. It looks like you're desperate for money. And if you're someone who's lending money, a lender, you're looking at this.
Yes.
Like, wait a minute, this person
Do I trust them?
Do I trust them? I don't even know what their habits are yet to paying me back. So why would I do that? I tell people establish the good habits around the payment history, paying things on time, staying below that 30%, and just establish credit history.
Yes.
Right? Sometimes establishing credit history means being on someone else's card, like an authorized user. And a lot of people don't realize that if you have someone in your life, like a parent or an aunt or somebody that you trust, and trust is important.
Yes.
Somebody that you trust, you can actually be an authorized user on their card, and that you kind of adopt what their credit history is.
It reminds me of like car insurance.
Yeah, kinda. Yeah, kinda. Yeah.
Like you can be in somebody else's insurance so yours is cheaper.
Yeah, so that yours can be cheaper. Yeah. So
you're telling me I can build a credit foundation on
somebody else's credit. You can.
I don't know.
Who has good credit habits? Let's
Right.
be honest about that. Who have good credit habits?
This is
so that's
mind-blowing.
true. And sometimes that helps people, right? Like I have a situation where a client had like a 560 credit score, and her now husband, it was her boyfriend at the time, had a higher credit score. He was like, I think he was like 805 was his credit score.
Go ahead, Kim.
Right? You all are thinking about building a life together, and part of building a life together means understanding where the money's going, understanding what your money situation is. When I had that discussion with her in one of our coaching sessions, it was an open discussion to realize I actually need to have this conversation with my significant other. The moment they had that conversation, and he was like, you know what? If I'm going to trust you with my life and you becoming my life partner, you're my fiance, I should be trusting you with the money that we have, because it's not just my money, it's our money. And our money kind of helps to facilitate the things that we want to do in our lives, right? You become one. The moment that he added her to his credit card, right, and continued his good habits and helping her to establish some good habits, her credit score moved from 560 to 750 within a matter of like 6 months or so. Yes. And that's just from the good credit habits that he has. And a lot of people don't realize that that authorization that you give, of course, you need to make sure the person that you're authorizing is someone that you trust, and that you establish in a relationship that, hey, I pay my things on time, so I need you to do the same, right? And then having that credit card over time, and you'll see it bump up. Like almost immediately.
Yes.
And so I do encourage that. And
wow,
folks do this, like parents do this a lot too, with children, right? Wow. So a lot of people are like, oh, well, my kid have to wait till they're 18 to establish credit. No. Your child has to actually be born and live and breathe and have a social security number. Like that's legitimately it.
Wow.
So anyone could really start to establish credit. It doesn't have to be until you're 18.
Oh my goodness.
Yeah.
So now that you have touched upon the whole mindset of being responsible, having good habits, being trustworthy, being able to understand your goals, your financial goals. Now that if somebody already have all those things, now what are the logistics behind credit? So what are those things that when you started the conversation, you said is the education part.
Yeah.
Where is it that we're lacking understanding of the ultimate topic of credit?
Yeah, I think the biggest piece that people kind of lack, honestly, we talked about the goals. It actually is the goals. You got to tell your credit what to do, right? So if your goal, for example, is to increase your credit score because you someday want to buy a home, right? The easiest way to do that is through consumer credit. Consumer credit is having a credit card. Establish a line of credit and utilize that credit card for things that you would normally pay for.
Okay.
Right? So that can be your bills, so your light bill, your gas bill, whatever you know you're going to pay for on a monthly basis that will get paid before the end of the month. Put those things on there. It shows good credit habits. It shows good credit history. By the time you get to the score that's ideal, which we typically tell folks, try to aim for a 720 to the 850 credit score. That's considered a good credit score when you're thinking about getting a home and a mortgage. The reason is because when you apply for a mortgage, this is called a hard inquiry. A hard inquiry hits your credit score immediately. So whatever your credit score is as a consumer, that credit card you have is going to be lower when you're going to go for a mortgage. There is a high cost to a low credit score. And it often comes in the form of interest rates. So if I'm going to go try to get a mortgage, I want the lowest interest rates. Well, the only way you can get a low interest rate is if you have a high credit score. So build the credit score, get a lower interest rate.
Wow.
Yeah. And so that's what I will say, right? It's just establishing and being very clear. What are your goals? Because the goals facilitate your habits. And I think oftentimes people want to work on this habit and then they work on it and it's like, okay, now what?
Wow.
Oh, wait, I didn't actually have a goal to this. So I do want to push that because it really is about how do I facilitate the life that I want by understanding the goals that I have and the tools that are at my disposal to get me there.
Yes. And I can see a correlation that your personal habits with your credit can influence big decisions such as purchasing a home and becoming a landlord, which can already be a business of itself.
Absolutely.
So can you talk more about the personal and business credit?
Business credit, yeah. People think it's like two separate things, and it's
I used to think that.
not. No. When you go to establish your own business, right, you know you have a good business idea, business model, you have your mission, and you have what you want to do. The next step is actually thinking about, okay, what do I need to make sure my business operates well? Right? You get all the necessary things that you need. Part of that is also getting a bank account, a business bank account. Keep your money separate. If there's anything I have to say about business and personal, keep your business money very separate from your personal.
And this comes to money that's coming out of the business and money coming into the business. So even if you're using your personal money for the business, if you have not yet made any profit in your business, if you don't see any money coming in and your account is on zero, even if you use your personal money to kind of have that foundational expense budget, you still want to put that into your business account, even if it's quote unquote your personal account.
Correct.
Because it's becoming business money.
It's because it is becoming business money. It's just expenses, right? When you think about your tax season, you have to write things off. So you still have business costs, right? And a lot of times when people establish their business account, they're usually establishing the checking account and they're doing their operations and paying for things, right? But establishing business credit is so critical in this entire process. First of all, it protects you, right? Credit cards is a protection, like it's somebody else's money. It protects you. But then second piece of that is when you go to apply for business credit, guess where they're looking? At your personal credit habits. It's like it's one and the same, right? The same kind of evaluations are being assessed.
Yes.
What are your habits? What are your payment history? What is your credit usage? All of those things are still being considered for your business credit. And when you establish that line of credit, which I hope folks do because now you have good personal credit habits, you then get an opportunity to start to track some of those records, track those expenses that you have, earn some points while doing it because business points are amazing points. Because your expenses are up, right? But it all gives you an opportunity to have information that's filed and logged. So by the time you go to do your taxes, you pull that report. Just from your business, your business stuff, right? Your business accounts. You pull that report. Everything is already designated. I tell business owners all the time, why are you using cash to make your business transactions?
Use credit money. Don't use your money.
And then, pay it off like you normally would. But you have a track record. That's the whole point, right? We all have to file taxes. And business tax is its own thing. And that's why I always tell people, your business tax is separate from your personal tax.
Yes.
So just make sure that you're filing. And it also depends on how you're set up, but you're filing right.
And so when I started the interview, I spoke on how the Queen here is going to touch upon personal, business, and generational wealth. Yeah. So how can the Black and Brown community start building that generational wealth? What is generational wealth?
Generational wealth, right? It's really it's passing down wealth. There's so many things that go into that. So I talked a lot about habits, right? Building that. So first of all, having a budget, building that out, what that looks like, lowering your debt. So if you are in credit card debt or other types of loan debt, definitely lowering your debt, living below your means, of course, living below your means, and then, saving for retirement. And when we talk about savings, let me be clear, because sometimes I think when that word comes up, people are like, oh, we know how to save. And they're thinking about putting their money in their bank account and savings. Like, yes, that is a thing. People should put their money away for emergencies, right?
Correct.
You should have an emergency fund. 3 to 6 months of an emergency fund is the golden rule. But after you've kind of maximized that, the next step is become an investor. Right? Like, you need
That
to
is
invest.
savings.
It is savings. And a lot of folks don't realize that when you have a 401k, either from your employer or if you're an individual who wants to establish your own retirement fund, like an IRA is an individual retirement account, you're an investor. Welcome to the club. The money that goes into a 401k or 403b, if you work for the government, or an IRA, is going into the stock market. And a lot of folks don't realize
Everything is connected.
everything is connected. It's a savings account. It's a long-term savings account, but it's an investment product. And so it's going into the market. So you're an investor. I tell people, take time to understand what you are investing in. Because the more you understand that, then you can start to leverage it to do even more investments, such as opening up a brokerage account, right? And when you open up a brokerage account, now you're in the market. What are some good investments that you can go in? Is it individual stocks? Is it mutual funds, ETFs, exchange traded funds? Sorry, I'm going into all of these like technical terminology, but it's important to know, because I think oftentimes when people hear savings, they automatically think bank account savings, and savings are also investments.
Yes.
It goes beyond. You kind of have to retire the bank account knowledge and
wait,
go beyond that.
remind them that when you have your money in a savings account, the bank is using your money to invest, okay?
They are.
And you're not even getting nothing. So why don't you talk about that? How to let go of that fear of losing the money? Because when people think about the word investment, they're like, "Oh, I'm risking a lot."
Yeah.
Can we talk about the risks and all that?
It is scary. It is a mindset. And I do encourage folks to definitely speak to a financial professional if you're looking to invest. Don't just go out and start investing without really understanding what it entails, right? What is your risk tolerance? There's a lot of things that do go involved. So definitely speak to a financial professional. That's my first.
That's right.
That's my first recommendation. My second recommendation is to also understand, like, what are you investing for, right? Just like I talked about with credit, what are you using credit for? It's the same thing. What are your financial goals? Is your goal to invest so that you can have your child go off to college someday? There's an investment tool for that. Is your goal to retire, I don't know, by 59 years old, right? There's an investment tool for that. Is your goal to create generational wealth? And maybe that means I want to invest in real estate and property. There's a tool for that. And so it's just really identifying what those goals are, to being able to speak to a financial professionals to express what those goals are and how you can get there, and what are the best financial tools and resources available to you to help you reach those goals.
And when you're speaking on that, mentorship and coaching and having that professional advice is so important. And this is where I want to talk about the importance of seeing people like you in that field, right? Representation. And I feel like it's of course another person that's from a different background from you can definitely help you as long as they have the professional background and expertise. But there is so much power in you understanding things at a deeper level. And how have you been able to see the lack of knowledge that's in our community, and how you're being able to impact them because you can connect to that level and represent them?
Oh my gosh, you about to have me go real deep. Well, first of all, I'm a product of my community, right? Like, I'm from the same communities that I go back and I teach financial health in. And so that relationship is already there. I understand the struggle. I understand all of that piece, all of those pieces. And I'm gonna say I had the privilege to be able to go through school, get a education,
Congrats.
and go get a college degree and have some experiences outside of the hood that I'm from, Roxbury and Dorchester. I went out, I lived in different places like I had mentioned earlier. That allowed me to gain some experiences, that allowed me to gain some mentorships like you talked about, and I got some knowledge. And now that I got the knowledge, I came back to Boston, right? And I'm working for an institution that allows me to, one, be able to spread this financial education and do so on a very hyper local. And then I have my own business, STC Coaching, where I do my financial coaching. I got to go deeper with folks because it's important. But as we think about all of those things, right, and why it's important, I also know that it's possible. And I think I came from a mindset that I thought that was something that was not for me or out of reach. And I was afraid because I had so much to lose. Like, I didn't have a lot, so I had a lot to lose. And so when I think about this terminology, investing, immediately I'm afraid. Because to invest means I'm also saying I'm comfortable with losing money, because I know that things go up, things go down, right? Like, we're in a season right now of inflation and we're technically in a recession. What does that mean, right? It's 2 consecutive quarters, 3 months and a quarter, where the GDP is negative. We're in a recession, right? And that could sound scary. And in those times you have inflation, prices up, and supply is low. Demand is up, supply is low. So things are going to cost more. So this is a scary time for folks to be like, well, I don't want to put my money in because the market is going crazy. Yes, and this is also when the market is on discount. Things are cheaper because the market is low. And I know that, like, if you're not used to investing, that's still scary because you're going to see your money go down.
Okay.
But what's historic is that money goes up. So, like...
Yes, so this is my most important question. What are the first steps that they can take? Because like you said, it's a big deal. Yeah. But some people think you need to start with 10,000, 20,000.
Okay.
Can you get into the...
Yeah, you don't need that much money to start investing. Absolutely not. Like, one of the first things I said to folks is that look into a brokerage account, right? A brokerage account, you can get that at any big name institutions. I don't know, I've dropped some, like E-Trade, for example. That's an online institution. Fidelity Investments, that's another one. Like, you can go to any of these ones, establish an account, a brokerage account. What is a brokerage account? This is an investment tool. In that account, you then get to choose what you want to invest in. You can do stocks, you could do mutual funds, you could do ETFs, you could do bonds, you could do all of these different things. Now, if you don't know what any of those things that I just said is, talk to a financial professional. Because they are responsible for actually explaining what all of these things are. Once you have that education, they'll also talk to you about your risk tolerance. Are you someone who is risk adverse? What I've experienced, a number of folks in our community are risk adverse. They don't have a lot to give. And so to be able to, like, you're going to feel risk adverse. But there's levels to that. And you may actually realize you're not so risk averse as you probably think you are, especially if you're younger. You have a little bit more appetite to be a little bit more risky, right? Just like a child. Like, I don't know, when I was 5 years old, I wanted to go on every single roller coaster. Now I'm in my mid-30s and I'm like, miss me with that, right? Like, your risk and how you kind of go off the ledge could feel different at different stages in your life, right? So understanding your risk tolerance is important. Again, with a financial professional, you'll be able to establish what those are. That's step 2. Step 3, once you do that piece, then you can start to realize for yourself, okay, if I am somebody who's risk averse, what are some bonds? Because that's very risk averse. What are some bonds that I can invest in? I-bonds right now are huge during times of inflation. It's immediate amount of interest that's given to your money. The maximum amount for an I-bond is $10,000. That is a thing annually. And so there is a max for certain types of investments. But to get started, you can start with a couple of $100. And that's what people don't understand. You can start with a couple of, whatever you have in your savings, start with that. Start with what parts of that, right? And if you're not in a interest-bearing savings account, get in one, right? And so what does that mean?
What are those? Yeah.
What does that mean? So in this time where inflation is high, interest rates on interest-bearing things such as like mortgages are going to go up. But interest rates for a bank account, savings accounts, certificates of deposits, for example, CDs, they're up. So if you looked at during the recession when they wanted folks to spend, interest rates for savings accounts were low. They want you to spend money. And so you probably saw interest rates at like 0.5%. Interest rates now for like a CD is at 3%.
That's incredible.
So if you are someone who's risk adverse, start there. Put your money from a regular savings account into a 12-month CD where you know you're not going to touch it because it's an emergency. For 12 months, get that 3% interest.
Yes.
Right?
Yes.
And so there's different ways that you can allow your money to grow based on what your risk tolerance is. And sometimes that is the first step before you get into the market. So,
and even like money markets, money markets accounts. Like if you don't want your money to be stuck, right, in a contract of a CD, maybe have it in a money market and you still have some interest, and then you can start feeling more comfortable seeing your numbers grow. And like I think it's a practice too, becoming more comfortable. So I don't know, are we good on time? Let me check, y'all.
I know. I feel like I can talk about this topic all day.
We good on time. So now my next question to you would be kind of going back to the credit.
Yeah.
Now that, let's say you're talking to somebody that have their credit in a really good place, what would be some of the steps for them? And then we're going to talk about those that their credit is not so good.
Okay.
There's some good steps for them to now move to the next level.
Okay.
Right? What would be the next level? I
love that question, right? Because that question goes back to my very first thing. What are you trying to do? Your credit is great. Now what? You work, and a lot of times, I'm so happy you said that. A lot of times people are working on a credit and have no idea why. Right? If I'm buying a house, my credit is good. Now it's time for me to get my money team together. What does that mean? I need to have a real estate agent. I need to have an attorney. I need to have my financial advisor. I need to have a mortgage lender. I have my money team, people who are going to help me to decide on where's the best home for me to invest in.
Can you say that one more time? Your money team?
Your money team, right?
Attorney?
You got to get your attorney, a real estate attorney. You got to get yourself a real estate agent. You got to get yourself some type of financial professional that's on your team, a financial advisor of some sort. And you definitely need to get a mortgage lender, right? Because you're going to need to borrow the money. And what are the rates? You need to understand what's needed and all of that. But you have to have that money team together. People try to go into home ownership without a team. You need a team. Because this is probably going to be one of your biggest investments of your life. Do it right. Do it right, right? And so you want to have that team together. That's important for a good credit score.
Yes.
People don't talk about this enough, but the second hard inquiry that people get is actually financing a car. People don't really talk about that enough, right? And so if you're trying to get your credit score right because you want to go and buy that car of your dream, that's actually important because when you go to finance a car, they're pulling your credit and they're pulling it multiple times to see who can give you the best rate. Right? There's a high cost to a low interest rate.
Wow.
So if you're trying to build credit and you're getting your credit scores pulled that many times, is definitely going to have an impact. And so what I always tell folks is you have to understand and know what you are building your credit score for. What are the goals associated with it? And how will you get there? What is your plan?
Okay, so this is now the big question. Because we have some people that are too extreme with planning, and then we have those that are too comfortable and too like, oh, tomorrow is not promised, I'm focused on today, right? We need to have a balance. So what are those different types of planning, and like what's that mindset?
That's great. There's a saying that says like, you fail to plan, you plan to fail. Right? That's like an actual saying, but what they don't talk about is that there's levels to the planning. You could plan way too much and then kind of hinder yourself from making moves, or you could plan too little and hinder yourself from making moves. So when you think about your goals, and that's going to be the big topic and takeaway of today, what are your life goals that have financial implications? Step 1. Step 2, are these goals immediate, short-term, mid-term, or long-term goals? Because when you get to identify where your goal lands within those 4 categories, you then now can plan from that category. So if this is an immediate goal, we're talking about anything from now and 6 months from now.
Okay.
Right? I'll say this, a goal without a date and a time is just a dream, honey.
Drops mic.
It's just a dream. Like, and let me tell you something. People just be out here dreaming and talking. Like, let's keep it real. People dream and talk all the time. Like, oh, this is my goal, blah, blah, blah. But they don't reach it. They don't reach it because they haven't sat with themselves and say, this is when I'm going to get it. This is how I'm going to get it. And this is why I'm going to get it.
So those are the 3 sections to planning.
Yes.
Date,
Yes.
when, how. So putting down the steps, the resources, the things that you're going to need to achieve that. And the last one was?
What is your why?
What is the why?
How is this connected to you? Right? Well, so we've been talking about home ownership, right? And for some people, that home ownership might be a long-term goal, right? You figure out your how. We talked about having your money team, going to speak to your financial person to make sure that things are in order, right? Tight and right, and your mortgage rates and things like that, right? So you know the how from there. Then what is your why? What is your why? When you start to be connected to your life goal in that way that have a financial implication, it drives you. It gives you that motivation to want to go and attain it. When you get really clear about your why, you're going to go after it because now you have a plan. Now you have the how, right? And so for some people, their why for buying a home may be security and safety. Their why may be, I want to create generational wealth. We talked about that at the top, right? Pass down my home ownership to my children.
Yes.
The plan for buying a home may be because I'm looking for a safe space. Something that's connected to me.
Security.
Right? And so get clear on the why, get clear on your how, find the date and the time to execute.
So this is perfect because earlier today I asked, not earlier today, but just a few minutes ago, I asked what would be the first few steps for somebody that already got their credit score in a really good space, right? This would be kind of like their type of planning. Now let's go back to somebody that their credit score is not so good. Then what would be their kind of planning?
Ooh, you know what's so crazy about that? It's not that different.
No.
The first step is realizing, oh snap, I have a bad credit score.
Yes.
Like
acknowledge it.
Like let's acknowledge it. Okay, what went wrong? How did I get here? Let's acknowledge that, but let's not stay there, right? Acknowledge it. I did this. This is who I was. Now I got to figure out who am I trying to be? Who do I want to be? And then figure out what are my goals? Because it starts there. What are my life goals that I have? Are these goals immediate? Are they midterm? Are they long-term? Are they short-term?
Okay.
And if I have a low credit score and I have a goal of a mortgage to buy a house, it's a long-term goal.
Okay.
You're going to need some time to build that credit score up, right? So now it's really about planning the how you would begin to build that credit score up. Now, some people may say, I'm going to get a credit counselor or I'm going to go pay for some type of credit repair. There's a lot of different options. There's a lot of different options. And I'm a big proponent of slow and steady wins the race. Things that are quick fixes. Life is not about a quick fix. But sometimes we are always looking for shortcuts. Shortcuts can get you in trouble in other ways. And so I like to tell people slow and steady typically wins the race. So if you're someone that needs to do repair your credit, for example, seek out first where you are in your city, right? We're from the city of Boston. Lots of free credit counseling opportunities, right? Why go pay for something when it's already offered for free in your city because it's a benefit for living in the city, right? So what are the resources that's at your disposal that you can take advantage of? Start there. That would be the start, right? Because once you have more information, then you'll start to figure out what your next steps are from there. But if you are someone with a low credit score, seek out the resources in your community that you are in that is free at your disposal.
That's so good. That's so good. Listen, I know there's been a lot because I feel that, but let me just do a quick recap for you. Credit is very important, but it's not who you are. So it is a tool for you to have to work for your advantage so that you can achieve your financial goals and financial stability. Credit, just like it is personal and business, work together. So it is important to have everything separated and in their own space, where you can have a good stable foundation, so that when you have to do taxes and you have to do, your bookkeeping, you have everything organized. All right. Then the next step is, how can you utilize credit to build that financial stability and generational wealth? And that comes into your habits and your planning, and how you're having your personal goals, making sure that you understand what are your short-term, mid-term, and long-term goals. All right. And then for those that are in this section where it's like, okay, my credit is not so good, I'm just getting started. The steps for you is to seek as much support and education possible, and start within your community. Don't look too far ahead. Look what's near you. So start researching, do that Google search. And you're already looking at this video right now. What can you do? Click that link on the bio, on the description, so you can have access to her information and her services. Okay. So start there. And then for those that are already in that, point in their lives where, okay, my credit is amazing, but I just don't know what's my why. I don't know what's next. All right, it's time for you to start reflecting on what it is you want in life. What is the purpose? What is the legacy that you want to leave behind? Is it a home for your family? Is it security for you? Is it that you want to retire earlier? Those things, start asking yourself, okay? Asking those good questions. I hope you found this really helpful. I did that recap real good, okay? Because it was a lot.
You got me over here smiling. I'm like, yes,
Yes.
please, check.
Thank you. No, seriously,
that's
thank you so
awesome.
much, and thank you, Sabrina.
Absolutely.
So
My
why don't
pleasure.
we end with you telling them where can they find you, your Instagram, your LinkedIn, and
Okay.
everything, where they can reach you.
Please. Yeah, please look out for me on Instagram. I'm _BREE, Bree, number 2, _BREE, number 2. And then on LinkedIn, I'm Sabrina Antoine Correia. I'm definitely active there, so that's where you can find me.
Yes.
All right.
Thank you.
Absolutely. Yes.
Thank you so much. This is great.
Yeah.
No, seriously, thank
That was
you.
So much fun.
Thank you.
Yeah.
Don't forget to hit that subscribe button and tune in for the next one, because the next one is going to be on fire. You thought this was fire? The next one is coming in hot. All right. Thank you so much, and see you on the next one.